Ever feel like you're David going against Goliath in the world of business funding? Well, you're not alone. The struggle for small businesses to secure funding is as real as it gets. Traditional avenues like bank loans or personal savings can sometimes feel like trying to fill a swimming pool with a teaspoon. They have their limitations. They may not always be available or sufficient or timely. But fret not, David had a slingshot, and we have alternative funding. Welcome, folks, to another episode on KeyTranche, where we explore the landscape of alternative funding. So, what's this slingshot we're talking about? It's like a breath of fresh air for businesses who've been shown the door by traditional lenders. It's a realm filled with opportunities, a vista of possibilities. Okay, you get the idea. It's pretty cool. Alternative funding, in all its glory, is a spectrum of financial sources that step in when traditional banks step out. It's like your best friend who lends you a tenner when your wallet is feeling light. Except, in this case, we're talking a bit more than a tenner. The big players in this scene, they're crowdfunding, angel investors, and venture capital. They're like the three musketeers of funding, each with their own unique skills and traits, ready to back your business when the going gets tough. But don't worry, we'll get to know them a bit more intimately soon. Let's dive into these options, shall we? First stop, the power of the crowd. Imagine the entire world as your potential investor. This is the magic of crowdfunding. Now, you may be wondering, what is crowdfunding? In essence, it's a method of raising capital through the collective effort of friends, family, customers, and individual investors. It's fundraising on a global scale, harnessing the power of the internet to reach out to the masses. There are four main types of crowdfunding. First, we have donation-based crowdfunding. It's a bit like passing around a digital hat, where people donate money to your cause or project without expecting anything in return. This type is often used for charitable causes. Then we have reward-based crowdfunding, where backers receive a reward based on their contribution level. You might receive a product or service in return for your donation. Next, we have equity crowdfunding. This is where the stakes are a bit higher, as it involves selling a piece of your business. Investors provide capital in exchange for equity shares of the company. And finally, we have debt crowdfunding, also known as peer-to-peer lending. It's like taking out a loan, but instead of a bank, you're borrowing from a crowd of people. Now let's talk about the pros and cons of crowdfunding. On the pro side, it provides access to capital, can validate your business idea, and is a great way to build a community around your project. It's like having a fan club before your business even launches. But there's also a flip side. With crowdfunding, there's a very public risk of failure. If your campaign doesn't reach its funding goal, not only do you walk away empty-handed, but you've also broadcasted your failure to the world. Moreover, crowdfunding is often an all-or-nothing proposition, meaning you either hit your goal and get the funding, or you don't, and you get nothing. But if the idea of appealing to the crowd doesn't sit well with you, perhaps some angelic assistance might. No, we're not talking about celestial beings, but angel investors can certainly make your business take flight. Angel investors are individuals with a high net worth or substantial income who provide capital for startups or entrepreneurs, often in exchange for ownership equity. These aren't your run-of-the-mill investors. They're usually seasoned entrepreneurs themselves who've made it big and now want to lend a helping hand, or rather, a pair of wings, to the next generation of innovators. So, what do these angels look for when deciding where to invest their heavenly funds? They're typically seeking businesses with a unique selling proposition, a solid business plan, and an enthusiastic team. But above all, they're looking for potential. They want to see that your business has the capacity to grow and return their investment. Now, let's talk about the pros of having an angel investor on your side. They don't just bring money to the table. They also bring experience, expertise, and an extensive network of contacts. In many cases, they can offer more flexible agreements than traditional banks, with less bureaucracy and red tape. However, as with anything, there's a flip side to this coin. With angel investment comes the potential for loss of control. After all, they're not just handing over their hard-earned money. They're buying a stake in your company, and they'll likely want a say in how it's run. Also, angel investors often have high expectations. They're risking their money on your business, and they're going to want to see it succeed. This can sometimes lead to pressure and stress. So, is an angel investor right for you? It depends. Do you have a strong business plan and the potential for significant growth? Are you comfortable with the idea of sharing control and decision-making? If so, An angel investor could be just the ticket to take your business to new heights. Still not convinced? Maybe it's time to fuel up with some venture capital. If you're ready to hit the fast lane of business growth, venture capital might be the high-octane fuel you need. Venture capital, often abbreviated as VC, is a form of private equity financing that's provided by venture capital firms to startups and early-stage companies with strong growth potential. These aren't your neighborhood lemonade stands. We're talking about businesses primed to become the next big thing in their industry. Now, how does it work? A venture capital firm invests large amounts of money in a business in exchange for equity or a share of the company's ownership. This exchange isn't just about the money, it's about the partnership. Venture capitalists often bring their industry expertise, strategic guidance, and a network of potential partners and clients to the table. It's like getting a co-pilot who not only fuels your jet, but also helps you navigate the flight. Now let's talk about the benefits. First, venture capital can provide large amounts of funding, often much more than what you can raise through crowdfunding or secure from an angel investor. This funding can supercharge your growth, allowing you to scale up quickly and seize market opportunities. Second, the guidance from experienced venture capitalists can be invaluable, especially when you're navigating the turbulence of high-growth business. But as with everything in life, there's no such thing as a free lunch. Venture capital has its downsides. The most obvious one is the loss of equity. When you give away a share of your company, you're also giving away a share of your control. The pressure can also be intense. Venture capitalists expect high returns on their investments, and they're not shy about pushing for fast, aggressive growth. This can lead to a high-stakes, high-stress environment. Whether you choose crowdfunding, angel investors, or venture capital, it's all about finding the right fit for your business. The key is to understand your business, your goals, and your tolerance for risk. Then, you can choose the funding option that will best help you reach your destination. Finding funding for your business doesn't have to feel like a David versus Goliath battle. We've explored the landscape of alternative funding, the power of crowdfunding, and the potential of angel investors and venture capital. Remember, there's no one-size-fits-all solution. It's about selecting the right fit for your unique journey. If you found this video helpful, don't forget to subscribe to KeyTranche. Also, like this video and hit the notification bell to stay updated on all things business and finance. Remember, every entrepreneur has a key to success, and at KeyTranche, we're here to help you find yours.